there have been these two long-running projects that we've had. The first has been the remediation and build back from the nickel situation in 2022, and commissioned an external report and came up with a whole bunch of market enhancements that we wanted to put in place to ensure that we built as robust and resilient a metals market as possible. But in parallel, we've had this long-running technology build program to deliver our new trading platform. And that went live on the 24th of March of this year. And that again was a real moment for us in advancing our technological and strategic agendas. And so we position ourselves to take advantage of what I think is a great opportunity for the whole market in the base metals as part of the energy transition, reflecting a lot of the trends that we're seeing in where the world is going. And it's an exciting time, I think, for the whole market.
How has the LME managed the recent challenges around tariffs and sanctions?
We have this sort of interlocking puzzle of geopolitical events. So we've had the sanctions environment, which has been getting more and more robust following the Russian invasion of Ukraine. And actually, as of April last year, we no longer allow new Russian metal to be warranted to be placed onto the LME. So that obviously changes some of the market dynamics. And then, of course, we have the tariff environment. The LME is a global contract. It was set up that way back in the 19th century, in a time when tariffs were actually much higher globally than they are now. So I think we in many ways benefit. We've inherited that legacy from our forebears who realized that a global duty unpaid contract was the right way to go, because it does allow you to have one global price that you can then add regional or country tariffs on top of. So I think we feel very good about the global nature of the contract versus a regionalized contract. But of course, the market has still had to deal with a lot of interesting situations. And actually, I think the most interesting is on copper. Because copper, as you know, the new administration came in and immediately started a so-called Section 232 investigation into potential copper tariffs. So we're in a position where we don't have copper tariffs, but we have the expectation of copper tariffs. And what that's created is almost a market where you have traders who are using the differential between the LME contract and regional contracts to speculate on the probability of those tariffs coming into place. We're kind of seeing almost a new use case for the contract. And I think it's something that we've had to manage, our industry has had to manage, but I've been really pleased by the resilience of the LME market.
What are the goals behind LME's plan to modernize its market structure?
The underlying challenge that we have here is, if I look at the LME's open interest, 75% of it sits on monthly dates, third Wednesday dates on our market, very similar to what you'd see with a normal futures, a monthly style futures contract. But because the LME also has a daily date structure, it's very hard for a trader, particularly an electronic trader, to come in and directly trade on our market July copper or September aluminum. They have to go in through the rolling 3-month date and then adjust. This has been increasingly an area where traders or prospective traders have turned around to us and said, look, LME, we really want to trade your market. We really want to have exposure to this asset class. But the way that we have to trade is just too difficult. If you could allow us direct electronic access onto those monthly dates, like we get on all of the great peer markets, then we trade a lot more. That we're asking people in our market, when they're trading monthly dates of less than 10 lots, that we would like them to go and put that business directly on the screen, because that will then drive, we believe, a liquid electronic market in those monthly dates. And then when other people come to the LME, they'll see that liquidity, and everyone will win from having that liquidity on copper on July, August, September, like many of our peers do.
How will you gauge success of your liquidity provider program?
the liquidity provider program, where we're going to incentivize members and clients to put liquidity onto those monthly dates, and the new LME Select functionality. Now that we have an in-house platform, we can add functionality much more easily. So we'll have a new order type which allows those small monthly trades to be put up on the screen in a transparent way as easily as possible. They are all, to your question, about driving that liquidity. So in terms of the metrics that I would look at, what really matters to me is that I sit down at an event here like IDX, sit down with perhaps a trader who's not doing a lot of business on the LME, and for them to say, look, I have logged on to LME Select, your electronic platform, and I'm really happy because I can see a liquid market on the things that I want to trade. You know, I want to go long September copper because I fundamentally believe in the copper story. I logged on to LME Select. There was a liquid order book. I clicked buy and I bought a couple of lots. Or, you know, I wanted to hedge my December aluminum production. I logged on to LME Select. There was a liquid December quote and I was able to sell into that. That's what I want to hear from our clients, right? And right now we don't hear that. We hear that they love our market, they love the physical structure, they love the macroeconomic relevance, but they don't like the way that they have to do this hop, skip, and a jump to get into the trade that they wanted to trade. And my metric will be that liquidity on the monthly dates, and then, but more importantly, clients to saying to us, this is working for us.
How are you leveling the playing field between OnExchange and OTC trading?
The LME has had a long and sometimes complex relationship with the OTC market. I think more than any other derivatives exchange, we do have this huge parallel OTC market where members will trade OTC with their clients, but on the basis of LME pricing. We're okay with that, but we want that to be on a level playing field. Back in 2017, we introduced the OTC booking fee, where we say that if people are embedding our prices into those OTC trades, that we ask that they pay for the use of those prices. When we first looked at the enhancing liquidity work, bringing that liquidity onto the monthly dates, we did propose that even OTC agreed trades should be put onto the central limit order book in order that the OTC market couldn't be used to avoid the new rules, and that there would be, as say, this level playing field in terms of everyone contributing to that monthly liquidity. A lot of our members came to us and they said, look, we're not going to use the OTC market to avoid your rules or to avoid fees. It's just that the OTC market is genuinely important for some of our clients who want to trade that way. So we've been able to come to an accommodation where we're now not going to apply the monthly block limit to the OTC market. We'll obviously monitor to make sure that it's not being used as an avoidance mechanism. We'll make some changes to the fee arrangements, but I think it's actually been a good example of where we've been able to work with the market, with our members, to understand their needs and to keep that OTC business going, but without imperiling what we want to do about bringing more liquidity to the book.
How are your explorations into sustainability of premium pricing for aluminum, copper, nickel, and zinc going?
The sustainability debate has really matured over the last 5 years. Right? 5 years ago, this sort of monolithic, net zero by tomorrow type model. And what we're now seeing is, I think, a much more thoughtful and a much more market-led approach to sustainability, where people are rightly saying, if I invest in making my product more sustainable, will I achieve an economic benefit from that? And I think that's the right way of going about this. You know, markets generally have the answers. So with metals, we have quite a lot of producers who come to us. So let's say an aluminum producer who says, you know, I'm currently producing aluminum fired by oil. And I want to invest in solar plants, right? A lot of Middle East producers currently oil-fired, but they have great solar potential, so they want to invest in solar and start producing really low-carbon aluminum. But then they say to us, well, LME, we're not going to get any more money for low carbon aluminum than we do for our current oil-fired aluminum, because the LME is a single price and we don't currently impose a carbon threshold. I don't think the right explanation or the right approach is to fragment liquidity, right? We don't want to have a high carbon contract, a medium carbon, a low carbon contract, because then you don't have that great global pool of liquidity, which is why the traders like to use the market. So what we've said, working with the industry bodies, the metals standards bodies, is that we're investigating, as you say, these sustainability premia, where we can say, okay, if you produce aluminum, which is less than 5 tons of carbon dioxide equivalent per ton of aluminum, and you subscribe to all the other sustainability dimensions, indigenous rights, water management, your land restoration, all of this important stuff, is there a market for your product to be sold at a differential, at a premium to the core LME product? And we're working with a spot platform, and we're saying with the industry bodies, to start looking at that. And look, I don't know what the answer is going to be, right? It might be that there's no premium, but I think that would be helpful to know. I hope that there will be a premium, because I think it would be good that the market is sending signals to producers to invest in that decarbonisation journey. But we don't know where it's going to end up, but it's a really interesting thing to be part of.